Hello, my name is Lourdes Fernando. I am with Fathom Realty, and today we're going to be talking about how to purchase the income property with a VA home loan. A little bit about myself. I'm a veteran. I served 11 years. Recently, this May, I purchased the income property using my VA home loan. I've used my VA home loan on a regular purchase on a single family home, and today we're going to share on all the details on how to purchase the income property.
All right, perfect. Thank you, Laura. So my name is David Piatek. I'm Senior Vice President at the Federal Savings Bank, where I specialize in working with military members, also currently serving Army National Guardsmen, also actually deployed. And I specialize in working with military members across the country to purchase properties, refinance them as well. So I'll be touching base on some of the different aspects of the financing piece. And Lourdes will be talking about the real estate portion of the transaction. 1 second here. So when we talk about, or when you think about multi-units, there's a lot of information that's out there, and there's a lot of misleading information. Also, throughout the last 2 years, a lot of things have changed with the VA home loan that should surprise you. So we're going to be covering that, and we're going to basically demystify some of the myths that are out there and all of the different aspects of the program itself, and also really how to purchase a multi-unit with almost no money and also be able to generate income. The agenda, I'm going to talk about some of the different aspects of the VA home loan itself, the different things that have changed, and then we're going to look at some examples. So Lourdes is going to lead us with 3 different examples, and then we'll also go over any questions you guys have. Now, you'll be able, then also this is going to be recorded. I saw a question up there. So we'll be able to share both the PowerPoint slides with you guys along with the recorded session as well. So what makes multi-units possible in today's environment is one big change that happened about 2 years ago is that there's no limit on VA home loans anymore. So if you qualify for $1 million property, you can purchase $1 million property with no money down. The only caveat to that is that you do have to have your VA benefits. You have to have your full entitlement available to you. So if you had a VA home loan and you sold the property, you have your full entitlement. If you're planning on selling your property, you also will be able to qualify currently with your full benefits pending that you sell your property at least a day in the same day, like do a sell in the morning and purchase the property in the afternoon. So there is no limit on that. So if you want to buy 800,000, 400, 200,000, $1.5 million property, you can do that. The big change that happened earlier this year is where you can actually use income from a prospective property to qualify. Whereas before you were not able to do that. So the main requirement for that is that you have to have 6 months of reserves. It could be in a checking, savings, 401k account, deferred comp account. We've seen it different ways, which actually adds a huge benefit for folks because before you needed 2 years of property management experience, and today you don't need that. The reserves consists of the principal, interest, tax, and insurance. So that could range for whatever your actual mortgage payment's going to be. You're going to have to hire a property management company, but Lourdes and I already work with property managers that will be able to help you with that. It's a minimal fee that you pay on a monthly basis. You're still going to need income to actually qualify for the property. So you still need to have some form of income yourself, which we're going to go over the different types of income that's allowed on a transaction. So we use 75% of the rental income to offset your actual mortgage payment. And you'll see in some of the examples that we go over, it's pretty substantial, right? A lot of times it can cover the entire payment for your mortgage, but you still have different expenses, right? People have cars, credit cards, student loans, whatever the case may be, that still has to be offset in some format. The great thing about Illinois is if you collect a 70% or higher VA disability rating, you're eligible to waive your property taxes. So it depends on where you're located. Property taxes can be pretty high. That's actually most of the places out here. They're pretty substantial. But you'll be able to get that waive with a 70% or higher VA disability rating. What's the max number of if you have a disability rating, if any kind, you don't pay what's called the VA funding fee, which can range anywhere from 2.3% to 3.6%, which is pretty substantial, and that's tacked on to the mortgage. But even folks that have a zero disability rating can be eligible to have their to have the VA funding fee waived. We've seen it multiple times. That's where you go in for a disability check. They relate it to the military. They rate it at zero, and then your VA funding fee is waived. One thing to note that we actually, Lourdes and I talked about this a little bit earlier, that if you file for your VA disability claim and you get a case number assigned to you, and let's say a month later, you're like, hey, I want to purchase a property. I want to purchase a home. You would still be charged a VA funding fee because your disability claim hasn't gone through. But what's going to happen is down the line, once that VA disability kicks in, you're going to retroactively get a refund of the VA funding fee in the form of a principal reduction. So you do get that money back, so you're not paying taxes on that. So that makes a huge difference. The max number of units that you can purchase with the VA home loan is going to be 4 units. So you can buy a single family, 2-unit, 3-unit, or a 4-unit property. And what happens if you currently have a VA home loan on the property? Well, you have some options. If you want to keep the property, or if you want to sell the property, that's easy, right? You list the property, you sell it, you free up all your VA benefits. The other option that you have is actually to refinance your current VA home loan into a conventional loan, into an FHA loan. Now, depending on the time frame of when you would be looking to purchase another property, would determine if it has to be refinanced as a primary residence or an investment property. Both of these have different criteria, and it's going to be a case-by-case situation. So if you guys have any questions offline, or if you have any questions, we can answer those offline as well. When we look at the financial snapshot, that's what a lot of people have questions on, especially veterans that have transitioned, they're in school. So we're going to go over that now. For employment purposes, if you're a W-2 salaried employee, it's pretty straightforward. Typically, they require 2 years, but there's a lot of exceptions to that, especially transitioning out of the military into the civilian sector. We're going to talk about from school to the civilian sector, what those requirements are. Typically, again, they're looking for a 2-year, but the VA home loan itself is very loose on what they allow. So they allow for job gaps. They understand that COVID had a big impact on folks that was negative, right? So if you had an 8-month job gap and it made sense, you would still be able to qualify for the VA home loan, right? They don't want to keep people down. They want to have veterans the ability to purchase a property. If you're self-employed, you typically do need 2 years of self-employment income. They do make an exception for 1 year, but if you do a 1-year option, they do divide the income by 24 months. So it just really depends on where you're at with that. If you go from self-employment to W-2, that's an easy transition. So if you're self-employed, let's say you do some type of medical sales, whatever the case may be, where you are self-employed and you transition to a W-2 salaried position, we're able to use the new salaried position income off the bat and use all of it, which is nice. If you transition from the military to civilian work, that transition is relatively easy as long as you can connect the dots between the transition and what you did in the military. But that's something, again, that we'll be able to help you guys with to connect. Just because depending on your MOS, depending on your rank, you have different responsibilities, and it can all correlate. On top of that, you might have taken some additional courses while you're in the military or during the transition process that might help you with that case. If you're transitioning from school to civilian work as a veteran, that's another piece that is relatively easy as long as you're getting a job in something similar to what you were doing or what you were studying in school. If you collect disability, which we'll go over a little bit in next, you can still qualify with your disability income and receiving and having reserves, right, in your 401k, TSP account, and your savings account to still be able to offset the mortgage payment for a multi-unit and use your disability income to qualify for the mortgage itself. Another big piece to that is that if you have a spouse, you're married, your spouse could be making all the income. You could not be receiving disability. You could be just going to school, and you'd still be able to use your spouse's income to qualify for the mortgage, even though you're currently not working. So that's an option as well. There's a lot of unique situation when it comes to folks just because of life. The National Guard and reservists face a lot of issues because they might deploy a lot. Like Lourdes and I, we've had a couple of folks recently that almost deploy back to back, but they also have civilian jobs, like at People's Gas, or they're police officers, firefighters. They work for the city. They have various jobs. We just had individual from the FBI, same kind of situation. They deploy a lot. How do we come up with that income? But again, that's something that we would be able to handle for you guys on that. Disability, Social Security, retirement, all that income you're able to use to qualify for the purposes of the mortgage. Now, if it comes down to future income, that is all going to be, like let's say future income, if you have your disability rating and you haven't received it yet, we're able to use that income. If you are going to be you're finishing school, you're going to be starting a job in 30 to 60 days, we're actually able to use that future income now to qualify you for the mortgage. This is why veterans have the ability to purchase properties the soonest out of any demographic because of that. Right? Most folks have to wait for a down payment. They need to already in employment. So that it's a big step. It's a big leap ahead for military members. Now, when it comes to assets, we talked about reserves. Down payment. You don't have to put a down payment on a VA home loan, but some people choose to put a down payment. Right? This can affect your VA funding fee because it changes with the amount of money that you put down. And then some folks want to use multiple VA home loans and they might not have enough entitlement. And that's something I didn't touch on. You can have more than one VA home loan at the same time. In fact, it's unlimited, but you run out of entitlement. And this is in the math class, so I'm not going to spend an hour just touching base on that. If you guys, the general rule of thumb, right, the thumb is going to be that the county limit, this is only for multiple VA home loans, is $548,250. So if you buy a $200,000 property and then you want to buy another place for like $235,000, you're actually able to keep both properties and just use another VA home loan with no money down. Remember, no outstanding VA home loan. There is no limit as long as you qualify for the actual mortgage. And you also need money for closing costs. Now, depending on what market you're in or the current state of the housing situation, which we know right now, the market's hot, right? We don't see as many closing cost credits from sellers to offset closing costs, but you still do see them. There's different ways that you can manipulate that, which Lourdes will go over here in a little bit. She's a wizard at that. So thank you, Lourdes. But again, you still need, at times you do need closing costs, but there's plenty of situations where people get a check for $1,000, $2,000. I think the highest I've seen is $17,000, but that was a property out in Cook County where the taxes are a little bit higher. And this is kind of the time of the year to buy because the next tax season doesn't start till March. So you kind of get the best of both worlds kind of in that time period right now. Credit scores is another thing that the VA home loan is pretty loose with. Typically, you're able to go down to, there is no limit. It just depends on the lender, right? So we're like, for example, for us, we're able to go down to about 600 credit score to qualify you for a mortgage. So it's pretty loose in that sense. Another thing that does count against you is childcare expenses. So if you pay, let's say, childcare and you claim that on your taxes because you want to write that off, that would affect your ability to purchase a property because it counts against your debt. So to count up front. VA home loans don't have a debt to income ratio necessarily. What they look at is what's called a residual income. So after you pay your taxes, you pay all your bills, how much money is left over, and then they have their own calculation for that. It's unique to everybody, and that's why sometimes people get pre-approved incorrectly because people don't submit all their information, like their taxes, their pay stubs, because all that's factored into you qualifying for a home. All properties are going to require a termite inspection, which the veteran can't pay for unless you're buying a condo on the second floor or above. And this doesn't apply everywhere in the country. Some places they let you. If you're buying in a rural area, then you're going to need a well and septic inspection, and that price varies. All homes are going to require an appraisal. So this is where a third-party appraiser that's certified by the VA actually comes out to the property to determine the value of what you're purchasing. Not only do they do that, they also make sure that it meets the minimum property requirements for the VA, right? The big things that they look for: carbon monoxide detectors, peeling paint, right? That's kind of the most common thing that we see. And then just depending on how the age of the property, there might be some additional things that pop up. Lourdes and I have been on multiple multi-units, and they're all unique. They're all snowflakes. With winter coming. And every property is going to have a different situation, right? If there is things that are wrong with the property per the VA, we're actually able to get waivers, right? So the VA, we submit it to the VA say, well, you know what? Yeah, you don't need to do this. You don't need to do this. And then the other option is that if it holds up a transaction, you're actually able to put money into an escrow account to fix the things that are wrong with it after you've purchased the property. And if, let's say, a garage is dilapidated, because I've talked to folks and they've come across a situation, especially when they buy out in like rural areas, or actually even in the city, where a garage might be completely dilapidated, it's falling apart. And if you don't want that to be considered part of the value of the property, then they can omit that garage altogether, so you don't have to even worry about it. So that's something that's unique with VA home loans, where you don't have that with other loan types. The difference between a home inspection and an appraisal: a home inspection is where a licensed contractor comes out to the property, or a licensed inspector. They come out and know all the things that are going on with the property. And trust me, even a new construction property is going to have some type of issues. They're like 30-page reports. You shouldn't, don't freak out about it. Talk with your agent. Potentially, you can get a home warranty to offset some of that worry. So, and then the appraisal is really to determine value. One thing to note too with the appraisal is that the property doesn't have to be in perfect condition. Most people think it has to be. It just needs to be functional, right? So you can be outdated. You can have shag carpet, right? We're bringing the 60s back. So that won't affect the appraisal, and they're not going to tell you if it changes to regular carpet or if to put hardwood floors in. It won't affect it. Trust me, some of the appraisals that come back without any issues is amazing to me. But it's definitely allowed. So now I'll let Lourdes take over from here.
Okay, so what to look for in a multi-unit. So the first thing the first thing obviously is the pre-approval. Once you have the pre-approval, then that's going to ultimately determine the location. So location is probably one of the biggest things that we look for in a multi-unit. Okay, so some of the things that we look for in the location, David, can you go ahead and, okay. Some of the things that we look for in the location is it has to be near transportation, okay? Highways, parks, restaurants, things like that. The more amenities you have close to your multi-unit, the better rents you can attract, and the the faster the turnover rate between finding tenants and everything like that. So that is very important. That's something that we look at. When we're walking the property, we want to make sure that we account for any type of deferred and annual maintenance. Okay, so deferred maintenance is, for example, David, can you go ahead and go to the next one too? Deferred maintenance is something that if it needs, the property needs tuck pointing, it needs a new roof, it needs new windows. In the near future, say the roof is good for about 4 years, you want to make sure that you account for any type of future projects that you would need to do, because ultimately this cuts into your cash flow. Okay, you want to make sure that you're selecting a property that the numbers are right and it has room for improvement. The other thing that you look for is annual maintenance. You want to include all the annual maintenance into your budgeting. So that includes the water bill, common areas. So, like the lobby area, snow removal, trash, landscaping, pest control, things that you have to do on an annual maintenance. Also, servicing your furnaces, things of that nature. Another thing that you want to look at is anything that has equity increase potential. So like David was explaining, you can use your VA loan multiple times. I know I've used mine on a single family home and most recently a multi-unit, but I want to make sure that this property that I'm purchasing has potential to have anywhere between 15 to 20% of equity potential, so that I can free up my entitlement. I can refinance this into a conventional loan, and I'll be able to use my VA home loan on another property. Okay. Some of the ways that you can increase your equity is by finding something that has maybe an unfinished basement. You can finish the basement to get that valuation there. You can expand units. So the property that I purchased, I'm able to duplex up. So I'm able to create additional bedroom counts so that I can increase that equity. Or the other way is if you find obviously a great deal. The market right now is very competitive. It's still a seller's market. So finding a great deal can be you have a property in a certain area where the comparables are a lot higher. So if you put in a little bit of work, then you'll be able to get that increase in equity. Another thing that we look at is development in the area. So that's another very important thing. What's going on in the area? Because any type of, when we're looking at investment properties, we're looking at it there's two things that we look at. We want to see the development, what's coming up, so you can get that increase in equity and increase in rents. So we'll go ahead and go to the, there's a question that we have, can we do new construction, David?
So you can't, as far as purchasing a new construction, yes, you can purchase a new construction with the VA home loan along with a rehab loan. And you can use the VA home loan to build the property as well, if that's the question. So yeah, you could do 100% financing on a new construction build. That includes doing a land acquisition where the bank actually buys the land and then develops it. If you guys want to get in more detail on the new construction, we can connect offline, because that is a very specific type of product that would take us like 30 minutes in itself to go through.
All right, thank you for that, David. So yeah, if you have any questions, please make sure you do put them in the chat, and we can answer those as we go. There's three ways when you're analyzing what your income property will be good for. Would it be good for rents, if you want to find long-term tenants, if you want to utilize government assistance like Section 8, things of that nature, and then the third one, if you want to convert it into a short-term rental. So I'm going to go over how to analyze those three methods on how to see what this income property would be best suited for. So the first thing that I always check is the local rents. There are some free tools out there where you can go in and do a quick little overview just to see what the average is. Of course, you would want your real estate agent to look over, give you an actual apple-to-apple comparison. But this is a good way that you can go and just look to see if it's even worth looking at. So you can go to Rent-A-Meter, you can go to Craigslist, HotPads, Zillow, Realtor.com, Rent Range, and all these tools, you simply type in the address of the subject property. Say there is one unit that has 4 bedrooms, 2 baths, so you put that in the search, and then you click analyze. It's that simple. And what that's going to do, it's going to bring up everything in that area within a 1 mile radius within the last 6 months that was sold for rent. Okay. So for this particular example, I put in an investment property that I was looking into, well, actually the one I purchased, but the average rent is for a 4 bedroom, 2 bath is $3,200. And then 75% of the rentals in that area is $4,000, and only 25% is about $25,000. So I stick at the average. We always want to have the lowest numbers just so that we can run the numbers correctly and see if this will work. So if we go to the next slide, how to check governmental programs and rates. So this is very important too, to know. You can just type in payment schedules or payment vouchers for your local community, and then this will pop up. You would be able to see how much a 2 bedroom is going for $1,355. Now, the way that these governmental programs work, they won't give you that full amount. That is the max that they'll give you, and that's very important for you to run your numbers, because they also look at what the rents are going for the area. If it's in a multi-unit, is it a single family home? What type of amenities? How upgraded it is? So the more upgraded your property is, then you'll get closer to that higher amount. But Section 8 does determine your actual, what you're getting per month. So this is just a good way to look to see if governmental programs would be feasible in your area. Okay. And then the next one is how to check Airbnb rates. So this is very simple. You go to the Airbnb website. Airbnb currently has the biggest market share out of all the short-term rentals, so that's why I'm going to be sticking with that. The way to actually get the month or the nightly rate, because that's what you're going to need, the nightly rate, to make sure to see if this is going to be a good income property or Airbnb, is you add the zip code, you put 2 adults, no dates, and then you'll click on the first comparable property. So if you are planning to Airbnb a basement unit, look at the basement units in that area. Okay, so type in the zip code, type in the address closest to that subject property, so you can see what's your direct competition and what's in the area. You click on check availability, and then you click on the dates. I pulled this, so this is my Airbnb that I have. It's a duplex down, so I wanted to see all the duplex downs in the area. And then I click on a Monday, something during the week, because I want the least amount per night that I can get to run these numbers. The reason that you want that is on the weekends, it's usually a lot higher than during the week, and we want the lowest number to run this comparison. So you're going to go in, you're going to click on the dates, you're going to click on include fees before taxes, and there it's going to show you the nightly rates. This one, the nightly rate for a Monday is $239. Now you want to take that and divide that by 15. Why 15? Because 15 is the weekends. Friday, Saturday, Sunday, it's half of the month occupancy, and typically that's when people want to book their Airbnbs, is for the weekend. Okay. The second thing that you want to look at is so this is a comp here. You want to make sure, a comparable here. You want to make sure that they're booking out Airbnbs in that particular area. So if you see a ton of vacancies or not enough Airbnbs, then it might not be a good choice for Airbnb. But here, what you're going to do is look at the vacancy. This one had 21 days occupied, and I pulled this at the beginning of the month. 21 days occupied, times that by 239. That's $5,000 for this Airbnb. That's what this is going to generate for that 1 month. If it's fully occupied, it's $7,409. So when you look at this, if the 15 days times the monthly rate is higher than the average rent, then it's going to be a good candidate for an Airbnb. And this I can go into a whole nother class. So if you have questions, you can always let me know offline as well, because this is a whole nother animal. But when I looked at the numbers, yeah, when I looked at the numbers, I was like, yeah, this would be a good Airbnb. One thing that you also need to check is your local your local city or village, just to make sure that they allow Airbnbs. Like in the city of Chicago, you can only have one Airbnb per address. So when I was looking for an income property, I needed to make sure it had 2 addresses, which was super hard, but I was able to find one that did have 2. So I do have 2 Airbnbs in my property. Okay. So the next thing that we're going to talk about is establishing a plan. Once again, location is you got to identify the location that you want to be in, because we can say, yeah, I want something in Chicago, but Chicago is very, very different. So it's best to really hone in into a specific location that you're looking for. Then you have to determine how many units you would need. Okay. What are your goals? What are you trying to do? And go ahead and click on the next one. So what is your goal? Is your goal to live for free? Are you trying to cut down your mortgage, or are you trying to cash flow? So that's kind of, I have some clients that say, look, Lourdes, I just want to, I just, want to, a $200, $300 mortgage. Okay, great. Let's get some 2 flats in this area because they really want to be in this area. Live for free, where your tenants are paying all of your mortgage, and cash flow is when you are making, after you pay all your bills, your mortgage, your water, all of your bills, you're left with some extra money. That's called cash flow. So you have to determine which is going to be best suited for you and your needs. After you determine that, then you determine if you want short-term or long-term tenants. And those 3 methods that I spoke about earlier is something that you can make that determination by. Once again, check your local rules and restrictions. I went into an area where I wanted to do Airbnb, and it wasn't allowed in that village, and I was fined. So I didn't know. It was a hard, it was a hard hit, and we ended up moving out of that village. Cried the whole thing. It was pretty bad. So just make sure that you do know your local rules and restrictions. Okay. Another thing is, how long do you plan to live in your building? This is something that you really need to know up front. Do you plan on living, like, for example, I'm going to plan to live in my building for 2 years, just because it's going to take me a little bit longer to get that equity potential based on what I want to do for the building. So it's going to take me about 2 years to do that, to build that equity up. So that's something that you should determine in the beginning. How long do you want to live in this building? Okay. The next thing is select the right team. Just make sure that your whole team is well versed. I've had situations where a lender can't close a multi-unit for a specific veteran, and then I had to call David and ask him, hey, can we do this? Can we do that? And how can we move forward on helping this veteran? So selecting the right team and having a realtor that's also going to be looking at it's going to run 2 sets of comps of what the current, what other multi-units, 4 units, 3 units are selling for, in addition to what are the rents, what you need the actual comparative market analysis on that. So attorneys, inspectors, the whole team is very important in this transaction.
Yeah, and there's a lot that goes behind that. Just to give you an example, like when we talk about using rental income for cash flow qualifying, I mean, I just talked to a couple people, and they were telling me they got disqualified because they couldn't use rental income with the lender. So not all lenders are created equal in that sense as well. And then to your point, Lourdes, too, is like, if the agent doesn't know the rental market, it's nice, like with working with you on this, because you provide all that information to the listing agent, right? You know the markets that need to, because the appraisers want that stuff. So a lot of this stuff is very minute details that have a huge impact on the transaction itself that sometimes you don't think about, right? You're just like, we don't even go over in this seminar. I mean, I teach a basic VA course, which is 8 hours long, and that just touches the surface. So there's a lot of stuff that happens in the background. We have one question that just came in. Can I purchase multiple properties with the VA home loan at once, and I have to stay in the property for a certain amount of time? So to answer the question, you cannot buy multiple properties at once, right? So it's really designed for you to have a primary residence. Okay, so just say, okay, so we got some clarity on this. So in order to purchase a multi-unit with the VA home loan, this has to be your primary residence. So if it's a 4-unit property, we should do it this way, then we only use 3 of the units income, and 1 of them is for you to reside in. If you buy a 3-unit building, same thing. We're only using rental income from 2 of the units because it's designed for you to live in it. In general, you can have multiple VA home loans. One, you can't purchase them at the same time because that wouldn't make sense from a primary residence perspective. If you want to layer different products, right? Let's say you want to buy a multi-unit, a 4-unit, and use an FHA loan. Put 3.5% down, and you bought a multi-unit. But someone says that we're frozen. Well, hopefully it catches up, guys. So you can use an FHA loan first to buy a multi-unit, let's say a 4-unit building, but then you outgrow it because you need more bedrooms and bathrooms. Then you're able to use the VA home loan after that, buy another 4-unit property, and then be able to qualify with all the income and still be able to purchase something, even if it's in the same area. If you try to use the VA home loan, let's say you buy a multi-unit, you refinance it into a conventional loan, use the VA home loan to purchase another property. It all depends, right? Someone asked, is there a certain time you have to reside in the property? Technically, there is none. You hear a lot of people say that it's 1 year, but it's really not, right? It's circumstantial. Like me, if I buy a property, like I bought a place while I was gone, right? I could rent that property out because it's circumstantial. I'm not living in that property. But a lot of times they want you to be there for a year. But again, there's no hard and fast rule on that. If you're deployed, and we just talked about this, we have a unique situation. If you're currently deployed, you can have a spouse or a kid, a dependent. Like if you have a child, they can live in the property even though you're not living in it. And if your spouse is staying behind and it's your home of record, they can also live in that property without you being there. So technically, for you, it would be an investment property, but it's designed to be a primary. So someone asked a good question. Can you buy a 4-unit in 1 commercial space? So the short answer to that is yes. In fact, you can buy a 4-unit plus a commercial space, being a total of 5 units. But that is very unique in the sense that it's extremely hard to get these types of loans passed through. Just from the sense that the VA has very limited appraisers, and we've only done it once, which was a couple years ago. Typically, we don't do the commercial space, but that is something that is possible to do. Good questions, guys. This is what I'm talking about. All right, now let's move into the fun stuff. Numbers.
Perfect. So how this is going to work, I'm going to show you what I look for with my clients, and then David's going to go over the numbers, and then I'm going to jump right back in and give you a little bit of if it's a good deal or if it's not a good deal. So our first example here is a 4-unit. This is in Chicago. This one actually sold for $195,700. So when I see a property like this, I'm like, okay, great. What are the first things that I look at? Okay, this one, the financing terms, if you go down to sales terms, it says a conventional FHA, VA, cash only. So these are the loans that they are accepting for the property. I look at what appliances, come with the property. I do see here there's a stove and refrigerator. Then I look at what the tenant pays, which is electric and gas. These are very important because you need to, once again, make sure that you're accounting for all of your expenses. Sometimes if a property manager is actually managing the property, it'll show us exactly all the expenses, which is located above the broker remarks at the very bottom, so we can actually see how much everything how much everything costs. Now, when you go under contract, you typically get the rent rolls, you get the expenses, any and every information that you can when you're under contract, but it's very limited up front. The next thing that I look at are the bedroom counts. So I see this one has a 3-bedroom, has 2 3-bedroom, 1 bath, and it has 2 bedrooms, 1 bath. And then I look to see the rents. Are there any security deposits? Also, the lease. Are there any leases on the property? And then once again, when you go under contract, they'll let you know what type of, if it's, say it's Section 8 or whatever type, if they're current, not current. So that information will be able to analyze once you go under contract. But just as a quick glimpse, I'm like, okay, this one is, listed at $200,000. It's a 4-unit. You have really good rents. Also, another thing to pay attention to is the tax amount. Okay, so you want to make sure that the taxes, are going to the taxes are important to look at as well, because in some areas taxes are a little bit higher. So David, can you go ahead and go over the numbers with this one?
Yep, perfect. So in this example, I stuck with the $200,000 purchase price. Also, just to kind of throw some caveat to how we derive these numbers. So I used a minimum of a 700 credit score, interest rates of 2.25, because I did this about a week and a half ago. And this is also providing that it's a first-time use of a VA home loan, not counting any disability. That's why you see a VA funding fee in here, and it's 2.3% of the purchase price. VA funding fee is the only fee that gets rolled into the mortgage, so to kind of set the tone for the other examples that we go through. So in this case, the loan amount is going to be $204,600. Mortgage payment $835. Real estate taxes are pretty low on the property at $137, and then you have homeowners insurance. Now, typically on a multi-unit, because there's renters in the property, the insurance is a little bit higher. We probably went on a little bit higher end, but it falls in line with what we see. So in this case, you have a payment of about $1,223 a month. We look at the rent roll on a 4-unit. Again, we took out one of the units for an owner's unit. So $850, and $950. So the total rent roll without the 4th unit is $2,650. So you're cash flowing positive in your pocket, $1,427. Now, from a lender perspective, remember, we're looking at 75% of that to qualify you. So for us, it's $1,987.50. So we look at what the net income is. It's $764.50. Now, one thing to also note with this is that you're not allowed to use excess income from your property as income. So in this case, we just offset the mortgage payment. But in reality, you're getting an additional $1,427. Why we use 75% is because because we use a 25% vacancy rate, meaning that a quarter of the time it's not going to be rented. So the requirement for reserves for the 6 months principal, interest, tax, and insurance is going to be $73.38 on the property.
Okay, David. So do we need to have that reserve amount? What if I'm able to qualify without using the rents?
Oh, that's a great question. So if you don't need the rent roll, then you are okay in purchasing the property with your own income, because some people do qualify. We've had clients qualify on their own with their own income. Another thing, guys, to note too is that, and then it takes time to purchase multi-unit, right? So never think this presentation is really designed for, you might have the ability today, but for others, it could take a couple years to get the assets to be able to do this or build up on credit or income. So you got to be patient with some of this stuff.
Okay, perfect. Yeah, with my personal situation, since I was a 1099, I don't have a W-2. It took me about 3 years to purchase the multi-unit just because I had to get all my ducks in order because I didn't want to get the W-2 job. But yeah, so it's possible. It is definitely possible. I think I hit David with every single obstacle and he was able to help me through it. So let's jump back into this example. So we do have a cash flow of 1427, which is great, and you're living in a property. So when you leave the property, say you refinance a conventional loan, you've been there for whatever, a year, and you now can add another 950 to this this 1427. So there's so many options with multi-units and different ways to run your numbers. When I'm there, this is how much I'm going to cash flow a month. When I'm gone, this is going to be my all-in. And one other thing that you have to consider with this property is there is a little bit of deferred maintenance, and there is some maintenance as well. This one was an as-is sale, and it had probably about $20,000 to $30,000 of work that needs to be done immediately because it had some city violations. So this is these are some of the things that you also have to consider to see if this is going to be a good deal. You have $20,000 to invest into your property. You're going to increase the equity very quickly, and you're going to be able to increase the rents as well. So these are just some of the things that you would need to look at. Can I increase the rents? And also, can I add some equity to the property?
That's good. Thank you, Lourdes. And we have a question. That's actually a pretty good question. And I'll read out the question out loud. So in terms of a process, do you look for renters first before the purchase or after? And if it's after, then are you going out on a limb with the big purchase and no renters yet? So from our side, from the lending side, we look, if there's renters in the property, we look at the current rents. If there's no renters in the property, we look at what the market rent is for the property. Now, Lourdes, you want to speak to when do you find the renters?
Yeah, so the agent can do an actual comparative market analysis on the renting side. You actually select, or if you do have renters, you can also, say, hey, I'm purchasing a building, blah, 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 but you usually do that after you purchase the property. That's when you find those renters. If there's current renters in there, like David was saying, when you purchase the property, it does come with tenant rights. So if they have the lease for X amount of time, you have to keep them in there until their lease expires. I had 2 tenants in mine. I gave the opportunity for both of them to break a lease for one of them, and the other one, the lease, I told them if they wanted to renew, this is what the new price is going to be, and these are the reasons why I'm going up on the rents. So those are some of the things that you can either keep the tenants that you have, give them the chance to break the lease should they want to break the lease, and then you can find your own tenants. You can have your real estate agent help you find some tenants. You can post it on, I know I had some clients that just posted it on Craigslist and different avenues, Zillow. So you would find your tenants after the fact. Now, you use the renometer, and those different tools to see what the rents are going for in the area, and then that's when you talk to your real estate agent so that they can actually give you the local rents, like apples to apples of what you're trying to rent out.
And Lourdes, would you say that it's a big risk to purchase a property with no renters in fear of maybe not renting?
Yes and no. So this just jumps back to your cash flow, because the property that I purchased had 2 tenants, and it had 2 Airbnbs currently. So with the Airbnbs, I was like, with COVID, it's kind of crazy. It's a gamble. It's a risk, because I don't have 2 tenants in that specific in the building, but I wanted to keep it as an Airbnb, and I had to live in the property, so I was waiting for one of the leases to go up or to expire so that I can move into that unit because it's owner occupied and you have to go into the property. So for me, I needed one vacant because I had, in essence, full vacancy. So I needed one of the properties. So it just depends on your situation, how much you're cash flowing. If you need to use the rent to qualify for the income, I would look at something that already has tenants in there so that you're not gambling with that. So that's probably the only suggestion that I would have.
Yeah, and it's very circumstantial to everyone's situation. But we'll take a look at the next example.
We do have a question. What programs do you use to manage your tenants? With the Airbnbs, I use a professional Airbnb management company. They manage everything because I have a full-time job and, I cannot, devote any time to that whatsoever. And then if you are using the rents, talk to your real estate agent to see if there's any type of management company that can help you and assist you, because you do have to live in one unit. So if they're managing a different one, you can have them manage the different unit and the whole building expenses, and help you and guide you through that process. And I would recommend getting a management company. There's a ton of them out there, property managers. Okay. So the next example is this one here. This one also is a 4-unit. And this one I was actually looking to purchase. It was on my list. Once again, you look at the rents here, you see that there's in the basement it has 1 bedroom, 1 bath, and then 2 bedroom, 2 units that have 1 bath, and then a 3-unit that has 1 bath. The rents are pretty decent. They're in the thousands. This one, it has 3 vacancies, and it has 1 month-to-month. This one is zoned multi-units. This one does have a garage. It's more updated. It's a little bit newer than the other properties. It was rehabbed. Does come with stove, refrigerator, central air. So this one does have a furnace and AC. The tenants pay for all the utilities minus the water. The owner is always in charge of the water and trash. And then you look down at the sales terms. They're allowing conventional FHA, VA with this property. And so this is just the primary information. David, can you go over the numbers on this one?
Oh, yeah. So we use the purchase price of $425, same thing scenarios last time with the VA funding fee. We total loan amount is going to be $434,775, payments $1,774, real estate taxes, and then we increase the homeowner's insurance a little bit, bringing the total payment to $2,359. So let's say $2,360. We'll round up, just like the IRS does. We look at 3 of the units, right, for the potential income, $1,200, $1,250, $1,000. So total rent roll on the property is going to be $3,350 minus the mortgage payment, which is going to be, you're going to be basically cash flowing $991 positive back to you. From a lender's perspective, remember we use 75% of that. So we're going to use $2,512, and then we show a net income of $152. And then the reserve requirement is going to be $14,158. And that's providing, again, if you actually need that income to qualify.
Perfect. So this one, going back, you're looking at a cash flow of about roughly around $1,000. Once you leave the property, once again, you can get another $1,000. So I looked at the rents in this area, and they're pretty low. So this one, you can also get increase your rents over time, just based on the area that you're in. And then when you leave, this one would be a nice cash flowing property, close to about $2,000. This one there was little to no work that needed to be done, which is good. So you don't have a lot of deferred maintenance, but you do have your annual maintenance that you would have to account for. We did have a question in regards to a lower price point. So we're going to use 3 examples with this presentation. We have one at 200, one close to that 400 price point, and another one at $1 million. That way you can see the difference between these different types, because yes, Chicago has, a little bit of everything, and depending on the areas. I did use a jumbo loan on my property. because I wanted the location. The area was very important to me. So we're going to talk about those examples as well.
Yeah. And then the one question about co-investors. So remember, this is designed as a primary residence, guys. So so you can have a spouse on a VA home loan. You can have two veterans on a VA home loan. It's called a joint home loan application. And then you can also have a non-veteran, non-spouse be on the mortgage, but it requires a 12.5% down payment. I won't go into too much detail on why that is, because that requires a whole explanation on entitlement and how that works. But yeah, you're able to do it. If a family member gives you money as a gift, they wouldn't be considered an investor, but that's something that is also possible. And that's actually one important thing I did not know earlier, is that if family wants to give you money, also let me know. I'll take some, number one. But you're actually able to use gift funds for down payment, and you're also, or not down payment, for closing costs. And you're also able to take out a loan against a 401k in order to purchase a primary residence with no penalty. So you keep your money in the market. You get basically almost a free interest loan. You still have to pay some, but not much. And then you just pay yourself back. So that is another option for that. And again, a lot of people forget that they have TSP accounts, especially if you've been out of the service for a while, and markets have gone up a lot. So it'd be worth investigating. My Lord, let's take it away.
Okay, and then the question also asked, does the real estate team secure the whole deal so that you're not stuck with a huge loan that can be a potential loss? So my recommendation is to, if you absolutely must use the rent, then use the rent to qualify. But I have a lot of clients, actually, my deal was the only one that I used the rent. All the rest of the multi-units, they actually qualified on their own. So they can completely cover the entire mortgage should, they have 100% vacancy. So that's one of the things that you have to really decide when you're looking at kind of like what your goals are. Do I want to look to a cash flow? Do I want to, do I want to put myself in this really bad situation? I'm a big risk taker, so I went for it. I was like, I'm very secure in my numbers. I did my research. I looked at the Airbnb, the government assistance programs. I looked at everything, and I was able to make sure that this is going to be a good investment for me. So far, it is a very good investment for me. I'm relying heavily on my Airbnb, but that's something I have experience with and I've done for the past couple of years. So nobody will secure the whole deal. That's why we wanted to put this class together, so we can show you some of the ways that you can double check, triple check, because a lot of people don't know of these resources. Okay. The next example that we're going to talk about, this one is priced in the millions. This one is on the north side, and it's a 4-unit. You have rents at $1,700, 20, 28, 16, 1900. So this is the rents are a little bit higher. On the north side, of course, also the purchase price. The taxes are also higher. When I looked at the Cook County Assessor's website, it's not assessed at that 1 million price point, so the taxes are going to go up closer to about anywhere between $12,000 to $16,000. So that's something that you also have to pay attention to. The tenants pay all of the utilities. It does come with stove, refrigerator, washer, dryer. In 2 units, you do have washer and dryers, which is great. This one, it has 1 unit is duplex down, and you can duplex down another unit. So it's a finished basement on one side, the other one is not finished. So you have a little bit of equity potential to get higher rents and increase your equity with this building here. David can go ahead and go over the numbers.
Oh yeah, let's go over them. So price point again on this property is $1,099,000. VA funding fee is substantially higher just because of the loan amount. So you're looking at about $1.24 million for the total loan amount. Payment is $4,589. Real estate taxes $767, and then homeowners insurance estimated about $350, putting you at an all-in payment of $5,706.96 on this property. Now, again, just to reiterate what Laura said, everyone's risk level is different, right? And experience with properties is different. So this is all kind of factored into how you perceive how you want to run the numbers yourselves, right? But again, these are the tools that you have in order to help you with that. So 3 of the units being rented, total rent is $6,450. So you're cash flowing $744. Based on our numbers using 75% of that, you're actually negative $869.46. So that's actually income that would count against you, or that would be the portion of the payment that count against you, right? And then the required reserves is $34,241.77. Now, keep in mind, when you're buying or if you're renting a property right now, like you're a renter, right? You're paying someone else's mortgage. Even in this situation where you're buying almost $1.1 million property and the loan amount's higher, provided again that you have the rental units rented out, which is 3 of the units, you're still cash flowing positive without having a mortgage payment. What that means is that over the next 30 years, if you keep that property, right? Most people end up selling over about 7-year mark, but if you keep that property for 30 years and you have it rented for 30 years and you don't make a single payment, in theory, you walk away with $1 million that you did not spend yourself, or you didn't have to put into a property, right? You always have to maintain a property, like Laura said, with deferred maintenance, but just keep that in mind when you're kind of going over this stuff.
Okay. So one thing that I would, if you go back to that last one, David, trying to get ahead. So one thing with this, and what I would do with this property specifically, is unit 1 is a duplex down. So this one's $2,800, close to $3,000. When I looked at the pictures for this property, it's semi-updated, not all the way. So you can also increase all of these rents. So that unit 4 is the owner's unit. I would do a duplex down with this one and be able to charge another $3,000, bringing your cash flow, adding about $3,000 to your cash flow, but you have to minus whatever unit 2 or 3 that you're going to take over. So when you are running these numbers, you want to make sure that you're going to live in the property that is not your biggest money generator, because that's something with the duplex down is going to cost you anywhere between $20,000 to $60,000 to renovate that building or that unit specifically. Just depends on what you need to do to it in order to generate the most. So initially going in, you're cash flowing $744, living in that duplex down unit, converting it, increasing the rents, and then moving up to one of the other units. That way you can maximize a little bit higher. This one is a little bit riskier because you do have to put that money in to fix it, and you won't have that equity potential to use that. You won't have equity yet to be able to use that to renovate these properties. So you do have to pay attention. This one's a little bit riskier, on the risky side. It canceled, it didn't sell. So it was a property that was on the market and then the seller canceled it, probably because the numbers were too high. So this is something that I would tell a client, saying it's nice, but this one you're going to have, unless you have the cash to fix up the property, this one probably is not going to be a good deal.
Yeah, and then just to touch on that, someone had a question about these numbers. So the cash flow is after the mortgage is paid. So you actually providing all the units are rented again, you'd be actually making $744. The negative $869 is, as a lender from the financing side, we actually count that against your income, right? So it's not a positive like with the other examples we looked at, where the entire mortgage payment was covered, right? So that's all we're able to basically omit. In this case, the rental income or the rental piece is going to actually be negative in this case.
Okay, David, does that mean so I had to qualify for at least $869 on a mortgage payment, in addition to all the rest of my bills and everything like that.
Correct.
All right.
That is correct.
So we can go in. Is there any other questions that we might have?
Let me take one step back. I made a mistake on something I said. You're actually able to use the positive cash flow, all of it, for the purchase of a property. So if you have $10,000 in rental income, we can use $7,500 as positive income for you. So I stand corrected on that. So let's go into the next slide. So this gives you guys a breakdown of renting versus buying. So you're able to take a look at how much money you spend on rent and what it accumulates over the years. Obviously, there's benefits to renting and buying. So this isn't something to show you like, oh, you're losing money. It's more of like understanding where you're at financially and then seeing how you can leverage the money that you have for the future. Like we discussed about multi-units, if somebody else is paying your mortgage payment, that gives you free cash flow or cash flow to do other things, invest or do whatever that you want to, or save up for the next property that you want to purchase. Understanding the next steps is really understanding your financial picture, right? Having your credit, income, full application thoroughly reviewed, and then setting up a comfortable spending plan, right? That's always going to make whatever makes the most sense for you guys and your comfort level. And that can grow as you look at more and more properties. And it's not always the right time to buy a place. If you don't qualify now, like I mentioned earlier, it takes time to go through the process. But if you don't set yourself up financially, have the numbers looked at ahead of time, there's no way you can be prepared for it. Lourdes, we've come across clients that were 100% sure they're qualified, they're good to go, there's going to be no issues. They don't get pre-approved. Like, no, I got this. It's too easy. And they go through the process. Then they fall in love with the property that they want to purchase. Then they submit an application. And it could be something small because, again, there's a lot of details in a transaction that that just kind of get overlooked. And they end up not qualifying for the property that they wanted. And it would have been easy to fix some of those issues if we had a couple months, right? So to just kind of give you an example on that.
Yeah, a good example with that is kind of my personal situation, and I'm very transparent, so I'll share. But 3 years ago, when I came here to Illinois, I fell in love with the multi-units. I was like, oh my God, I want one. So I talked to David 3 years ago, and he was like, all right, you need to pay off all your debt. You need to increase your credit score, and I need to show 2 years of you making income as far as your job, because it's very difficult for me to qualify. Because I can write, as an entrepreneur, I can write off a ton of things. And David was like, don't write these things off. Got to pay extra tax money on some things because I could go to town with the write-offs. But I had to, and I followed his guidance. And then I needed a new car because I couldn't write off my car after 5 years that I had before. I even called David at the dealership, like, do I, finance this, or do I pay cash, or what do I do? And where do I need to stay per month as far as monthly payments? Because I'm also a disabled veteran, so I can use some of that income to qualify. So David, through the process, even before I filed my taxes, I said, look over my taxes. I know it was kind of extreme, but I really had these goals set in mind. I really wanted a 4-unit. I really wanted a specific area location, and I really wanted a cash flow. So this did not take me overnight. I literally planned out my steps, from the beginning. So just to let you know, it can happen overnight, because I have a lot of clients that come in and they're qualified, or it can take a little bit of time, like it took me. Okay. So find the right property. So if you do have any questions, we can set up a free consultation to kind of go over your planning process, when's a good time, location, what you should look up, what you should look for. And then review the areas that you want to live in, because that's very important when you're putting together your plan. And then you search for properties. Of course, by this time you do have your pre-approval, and you do know kind of, you do have your, your plan set. And then
that's Lourdes.
That's me right there. So that's the building that I purchased in May, and I did use my VA loan. With this, I was able to roll in my closing costs on top of the loan, because this particular property had a ton of price reductions. So it had no problem appraising that amount. So I just, instead of me bringing money to the table, I just rolled it on top of the loan, had the seller pay a little bit of it. And then this one did have 2 Airbnbs that were fully functioning at that time. So I took over their management company, everything, how they had it laid out, and then also negotiated all the furniture into the loan as well. So I was able to tack everything on top of it. So with this one, I am cash flow positive. I am living in one of the units, because you do have to have owner you do have to occupy the property. But this one, I do have a lot of plans to increase equity and to go ahead and refinance it into a conventional loan in 2 years, and then be able to purchase another building. So that's kind of my plan. And if you have any questions, please feel free to reach out.
Awesome. Thank you, Lourdes. Yeah, if you guys have any questions, you can drop them in the chat, and then we'll be able to answer them. Otherwise, we can jump on a call with you guys at any time. You can reach out to us on my cell or email. If you guys might get a hard time getting a hold of me after the seminar, because it is nighttime by me. As you can tell, it's dark. So if anything, I'm easily available tomorrow in the morning at any time. So if you get up at 2 a.m. and want to call me, I'll be available. I'll be available pretty much from 11 p.m. until 2 p.m.
Okay.
And then Lourdes,
so we do have a,
yeah.
what?
I had a
have
question. Oh, it's delayed.
Go ahead, David.
To both people asked the same question. So we're going to send out the PowerPoint. I'm going to send it to Kevin. He's going to send it out. Lourdes, you can probably stop the video, and then we can, it's going to save, and then we're going to send out the videos out to you guys. So you guys can review them again, just to make sure that if you have any additional, again, just review the material and then give us a call with any questions, or shoot us an email, text message, whatever the case may be.